Hello everybody. So this video is entitled Him Stock. We've borrowed 350 million at 0%. And of course it's convertible debt, so it will be paid back via dilution, but dilution in 2032 and dilution at a nice premium to where the stock is trading today. And of course, as is always the case with HIMS, no matter the news, no matter what type of news, the stock is always down. The stock is always so volatile. Whenever you have any type of news, the stock goes down. It's really the quiet periods where the stock slowly goes back up. But this reaction, minus 10%, of course, over the past 3 days, is entirely nonsensical for what I view as a very good thing. This convertible debt is a very, very good thing because we're borrowing at 0%, which means we get 450 million and we have nothing to pay until 2032. And if in 2032 we trade at above $29.53 a share, if we trade more than that, which, most people would probably think we're going to trade higher than that, then we would pay via dilution. We wouldn't pay via cash. We would only pay via cash if you thought the stock was still going to be $22, in 7 years, right? 6 years. 6 years from now, if you think the stock is still $22, we're going to pay back with cash. But if not, we are paying back via dilution at 29.53, which again should be very bullish because this is the same as us. This is very similar to us issuing the shares now at $29. We're not trading at $29 right now, right? So it's future dilution in exchange for money today. And of course, another thing the market should be very excited about, as somebody who follows this company pretty closely, I want to see them invest in AI. And what do they say the funds are for? Of course, they say it's to preserve financial flexibility while executing on its international expansion strategy, including the acquisition of eucalyptus. But that money is not for eucalyptus. Remember, they borrowed over $1 billion last year at about this time at 0% too. So they have a lot of cash, but they want to keep the cash. They want to keep being a cash-rich balance sheet. That's what they are doing. That money is fungible. Of course, the money that they are using for the acquisition, you can't really know where it comes from. Likely comes from, in my view, the $1 billion $1 billion debt that they did last year. This, the amount borrowed today and the terms today, of course, are not as good as they were a year ago. But a year ago, the stock was trading very high. The stock was not hyped up, but the stock was liked by the market a year ago. But today, we borrow way less too, right? We're also borrowing way less than we were before. So it's not as big of a deal. The big deal, which I wish the market was reacting to, is the fact that they're specifically talking about scaling AI capabilities, talking about the consumer experience, talking about the closed-loop data ecosystem. This money is going to go towards AI, and I fundamentally believe this company's future includes AI making the decisions, AI doctors making the decisions, again, and the laws will evolve over the next 6 years, and even if you still need providers to approve the request, the AI will make the work of the provider so much more efficient that you don't really need to grow the number of providers as the number of patients coming on the platform increases, hopefully exponentially. You may not need to grow the number of providers by very much because you have so much AI assistance, you have MedMatch, you have AI designed drugs, AI designed compounding medication of all sorts. Everything's going AI in this company, and in my view, even their marketing is going to go AI. Everything's going to go AI. I want to see them invest in AI, and this is what they're doing. So if you follow this company from a fundamental matter, this is really good in my view. Furthermore, as is usual with these types of transactions, it's a capped call, right? So of course, if you buy a call at $50 a share right now for 2032, it's going to be dirt cheap. It's going to be much cheaper than of course selling one at a lower price, which is essentially what they did, right? They essentially sold a call for the 0% debt. They essentially sold it instead of interest. A convertible debt is kind of a way for a company to get a premium, and so they collected that call premium on themselves via the convertible debt by selling it at 29.50, but they probably bought the $50 call, which is a capped call. They probably bought it for much cheaper, because those $50 2032s are way out of the money. And of course, this is all OTC, over the counter. It doesn't trade in any form of exchange. These very long dated options are, kind of an obscure market. If you follow my Michael Saylor videos, Saylor always talks about how obscure these types of transactions are, as opposed to the liquidity of, mainstream exchanges. But anyways, to recap, in my view, this is very good. We have 0% debt that we get to pay back if we don't trade above $29 in 2032. And in that case, this is enormously positive for him in that case, because we just pay it back or roll it over, right? Refinance it. You could also refinance it, and you ended up paying 0%. So they took the bad trade, right? The convertible arbitrageurs, the convertible debt took the bad trade because the stock didn't end up trading at above 29. Of course, I believe the reason why they bought so much debt, why they bought all of that debt, is because they think that it's going to trade above 29. Otherwise, why would you, right? They think it's going to trade above 29. The bond investors, the convertible bond investors, think the stock is going to trade above 29 in 2032. So that's the good news, right? And of course, it's likely going to trade much more than $29, which is why they're probably buying it. And then, of course, if we trade above that in 2032, we will be paying with dilution. So we'll be printing our own shares to pay for that debt. At $29 is what we'll be paying for with dilution, right? And the max dilution, right? Because if the stock is trading at 40 and you're issuing shares at 29, it's a losing proposition for HIMSS. But there's a cap to that losing proposition, and the cap is at $50.15, which means that if we trade at, say, $200 in 2032, we're actually not losing, 10x what we would have lost if we traded at 29. We're actually not losing that, right? We're losing way less. We're capping the loss. We're setting up a max loss potential by doing it at 50. And it's called a capped call transaction. And the maximum loss above $29 would be $20.69. So again, in my view, this is a win-win. This is a very good deal. This is a type of debt, in my view, that any private person would jump on right away and take on right away. But of course, private persons can't do that. The second way to get exposure to that shorting of the US dollar, that shorting of the currency, is to buy companies who get access to that cheap debt. But unfortunately, as private investors, we can only dream of this type of deals. Companies actually live in this world. And so you have a company that is still dirt cheap, company trading at 0.09. Forward revenue growth is 32%, and that includes, by the way, the guidance from HIMSS, their own guidance for 2026, and the more than $200 million, 225 likely, more than that, of revenue that we're going to recognize in H2 from the eucalyptus acquisition, which was not included in the HIMSS guidance, right? That's how I get to 32%. The HIMSS guidance didn't have eucalyptus in there. Once eucalyptus is officially acquired and they issue new guidance, you'll see that number improve greatly because, of course, by acquiring eucalyptus, they acquired tremendous revenue. They acquired 450 million ARR when they announced. By the time they actually close, is it going to be $500 million dollars in ARR? Is it going to? So you just bought 20% revenue growth. You just bought, well, it's actually 10%. 70%. You just bought 20% revenue growth. If we had 500 million, you bought roughly 20% revenue growth with 0% debt. Amazing. Again, the stock, to me, lots of opportunities coming up with international, lots of opportunities coming up with AI, lots of opportunities coming up with expanding the tried and true strategy that they've had in the US, the success that they've had in the US. for all of these different conditions, expanding them to Europe, to Canada, to the rest of the world. This is a business that I look forward to owning into the 2030s and perhaps even beyond than that. This is a stock to me that is doing so well under the hood, but unfortunately misunderstood by the market, and unfortunately gets shaken around all the time by Mr. Market. And that's just the way it is when you buy high growth, innovative companies that are misunderstood by just about everybody, whether it's traditional Wall Street or traditional health investors, traditional pharma investors. Nobody understands this stock because it's a 0 to 1 stock, but they will. Eventually they will. At least that's my take. This was not investment advice. This is not financial advice. This is only entertainment. I'm hoping you were entertained. Please like, please subscribe, follow me on Patreon, follow me next. Thank you for watching, and have a wonderful, wonderful day.